welcome to the first Prescient China webinar of the year. See, there are still people joining the webinar, so just going to give it 1 minute before I jump straight in. So today it's just going to be myself running through the webinar today. For those of you that don't know me, my name is Tian Pan, and I look after Prescient's China range of strategies. If you do have questions today, I think there's a chat box, so feel free to post questions, and I will try and get to all of them at the end of the webinar. We don't have a very long webinar today. I'm expecting it to be around 30 minutes or less, and then we'll have plenty of time to go through a Q&A session, hopefully where I can answer any of the concerns anyone may have for China and the crazy world that we are living in today. Okay, so I see quite a lot of people have joined, so I'm going to jump into the webinar. Please feel free to type into the chat box if you can't hear me clearly. I'll be monitoring the chat box just to make sure all the tech and everything is fine. I'm going to jump straight in, and I think uh, I mean, before Iran war happened, I think 2026, we thought it was pretty much going to be China's year. Why? Because all of the Trump-related sort of tariff conflict, foreign policy conflict, everything in 2025 died down very, very quickly towards the end of last year. And since late 2025, the Korea meetings between Presidents Donald Trump and Xi Jinping, the tone shifted drastically. So now the US is on a sort of a friendly coexistence or friendly competition type of state, where the two countries are warming up. For example, China buying more US soybeans, the US allowing more advanced chips, for example, the NVIDIA H200s to be sold to China. Things are not still, the two countries are still not best buddies yet, but we are heading in the right direction. So we expect up to four in-person meetings between Xi Jinping and Trump this year. So the first was actually originally scheduled for the end of this month, where uh, cool. Okay, so the presentation showing up on admin screen. Uh, let me try and reshare the screen. Uh, wonder if this is better. Okay, guys, please let me know if the presentation is now in full screen. I think I did do a bit of a change. Let me know if that's working. I'm still looking at the Q&A box, but I'll carry on. Um, yeah, so up to four in-person meetings. So let me click the last bullet point. Most of you would have seen it from the presenter screen. So Trump was expected to visit China on official state visit later this month, but because of the Iran war, it's been at least temporarily delayed by about a month. So we expect Trump to visit China in April, May, either late April, early May, if things don't deteriorate with the Iran war. We are actually very positive on the bilateral visit. So ahead of time, a lot of the high level teams within government, both US and Chinese government, have been negotiating for potential deals, economic deals, trade deals, etc. So once the two leaders meet, hopefully in April, May, we expect a lot of positive announcements. Unfortunately, it has been delayed by a month, but we do expect positive developments in bilateral relations. So with the US midterms coming up, Trump needs quite a lot of economic support from the Chinese side, given the sort of, especially with the Iran war, inflation coming through, US domestic economic numbers not looking good. So he needs all the help he can get. So with that in mind, we are actually also hoping for the conflict in Iran to sort of quieten down within the next month. That's a best case scenario, but we'll need to remain sort of cautious and watch out for developments in the Middle East, and then obviously its impact on the markets. If we look at other countries, the general impact of the Iran war, if we just look at China first, China is really probably one of the least impacted by the war in Iran. So, for example, Chinese vessels currently, from the Chinese side, it is reported that Chinese and Iranian vessels are still allowed through the Strait of Hormuz. So, although we believe there will be impact on energy shipments from the Middle East to China, the impact will be a lot less than the rest of the world. China, on the other hand, I mean, those of you that have followed our webinars, China has been struggling with a risk of deflation or risk of persistent deflation. So a little bit of higher oil price, not as bad for China compared to the rest of the world. China is also just structurally, as an economy, way less dependent on oil than most other developed economies. So if we look at EVs, electric vehicles, more than half of all new passenger vehicle sales in China are all electric. China is the world leader in renewable energy, so things like solar energy, hydroelectric power, and also China has invested heavily to develop the latest generation of nuclear power over the next decade. So China is still heavily dependent on coal, but largely less dependent on oil than a lot of industrialized economies. And I mentioned earlier, I think if I go back to the previous slide, the last bullet point here, where Canada, so just this year so far, we're only in March. Countries like Canada, UK, Germany, all have already visited China. So Canadian Prime Minister Mark Carney obviously made headlines with his speech in Davos, calling on the world to sort of counterbalance and manage sort of domestic interests given the Trump risk. So even we are seeing the closest allies of the US, countries like the Canada, UK, and Germany, all turning towards China, not necessarily as political allies, but for economic and trade diversification from the current Trump administration, who will be in power for almost another 3 years. So everything looking quite positive for China. And just to follow on for this slide, just so a bit of a disclaimer, the photos on these first two slides are all AI generated and as of leaders of the it's obviously leaders of the US, UK, and Germany. So if we move on to how the markets have moved. So this slide shows how the markets have moved since the Iran war began, or since the US started bombing Iran on the last day of February. Um, the red line is onshore CSI 300, the onshore Chinese market. The purple line is MSCI China, the Chinese offshore benchmark, and then the light blue line is S&P 500. So we can see if we look at the bar chart on the right-hand side, all the markets are sort of negatively impacted. By the way, the dotted blue line is our Prescient China balance strategy, actually doing the best out of all the indices, given its sort of risk-controlled exposure. Um, if we look at the S&P, it's actually done the worst out of these markets, all measured in US dollar terms. The MACI China and Chinese onshore markets returning similar over a short 2-week period. But if we look at the line chart on the left, it's that additional volatility that we see in the offshore Chinese markets that we talk about, especially in times like these when there's just global uncertainty and global shocks. The Chinese offshore markets react a lot harsher, and that's why we always like to add protection within our Prescient China strategy. But I'll talk to strategy a little bit later in today's presentation. If we move on to currency, so the currency, the higher numbers are on these charts, the worse the depreciation of the currency since the end of February. So obviously the rand has been hit pretty hard. The rand depreciating by more than 4% over the past couple of weeks. So has the euro and the sterling. So the euro depreciating by almost 2.5%, sterling almost a full percent, whereas the Chinese yuan very, very stable, hardly moving, just depreciating by 16 basis points. So pretty much unchanged since the war began. Although a little bit of interim volatility at one stage, the CNY was down about 80 basis points, but recovering to where we are. So overall, again, China pretty much, I mean, both economically in terms of the physical economy and financial markets in terms of stocks and its currency, very much the most stable major market since the bombing of Iran started. So, actually, that's pretty much all the geopolitics that I'll cover today. Feel free to put questions into the chat box, and then I will speak to them a little bit later. And then we move on to the data. So it's a combination of end of 2025 economic data and some of the latest data from February that we are seeing. So if we look at economic data, China's actually doing very, very solid. So 2025, the country met its growth target of 5%, fourth quarter growth of 4.5%. CPI doing really, really well. It was hovering close to zero for a couple of months. So it's sort of getting away from zero, above zero, and then getting back to zero this month, or not this month, end of February, we saw. So still without the impact of higher oil prices, pretty much in range of that 1 to 2% range that the Chinese central bank uh, is targeting. We are hoping for the number to consistently stay in a healthy range. Core CPI at 1.8%, so that gives us more confidence that we're not gonna hover back towards that persistent deflationary risk area. So quite comfortable with that. PPI is still negative, but if you guys remember the large negative numbers we saw just a few quarters ago, PPI minus zero point 0.9 is actually quite positive. So everything is color coded on this slide as usual. The red is obviously not a good number because PPI is negative, but the trend is actually quite positive. That's why we have sort of the gold neutral color commenting on the decelerating declines in PPI. So hopefully we'll see PPI hit zero and then positive over the next couple of quarters as the trend develops. Consumption is one of the numbers that we continue to want improvement in. So as at the end of Feb, we have seen improvement since December. So since the end of 2025, at the end of December, we saw retail consumption only increase by 0.9%, which is very disappointing. The only saving grace for that was that it was above zero. So just to give everyone an idea, if the Chinese economy wants to switch from an investment focused economy to a more consumption driven economy, and the economy is growing at 5%. We want retail sales and retail consumption to be growing at north of 5%. Right now, we're way below that target, although the trend is quite positive. We move over 2 months, we move from 0.9 to 2.8. But then again, these are sort of monthly data. We need to have a look to see how overall 2026 number looks. And we do expect a significant improvement from that 0.9% of 2025. So the economy is recovering. Exports 21.8% in February. It's more sort of a timing issue. Uh, so Chinese New Year typically falls in January and February, depending on the lunar calendar. So it just happens that this Feb's reading, or it's pretty much a January and February reading, is quite a lot higher than last year. We do need to look at full year numbers, but overall, if we look at the full year number for 2025, it was positive 6.6%. Exports were the main drivers of Chinese GDP in 2025. We continue to expect exports to drive the Chinese economy in 2026. Property prices remain depressed, and the declines we expect to continue. I think we said in 2022 that properties were probably going to be a decade drag on the economy. We are year 5 into sort of the property downturn. We continue to hold the same view that we said in 2022. So we don't expect any rebound. So all the policies that we are seeing in China continues to be aimed at stability. So a stable, managed decline in the property sector. In terms of our portfolios, we have around indirect 0.5% exposure across all our China portfolios. So no more than 0.5% indirect exposure. So we remain sort of cautious and bit bearish on the Chinese property sector and related assets. If we look at this was a chart I actually showed in last quarter's webinar, but we have some updated data from the Chinese central bank as at the end of 2025. This is actually a chart that makes us very bullish, or gives us a lot of bullish potential for the Chinese equity markets for 2026. So all of these bars are calendar year household savings by Chinese households, so the private sector. If we look at everything that sort of sits on Chinese central banks records, almost 24 trillion US dollars are sitting in savings cumulatively. So the bars in the background are per calendar year, and everything that's in this green block is cumulative. So of the 24 trillion dollars or so of savings by Chinese households, almost 6.5 trillion, so 6.4 trillion sitting on demand deposits. So what we know in South Africa as current accounts, earning zero interest, ready to be deployed to anything, whether it's consumption, investments in property, or that the Chinese will love, or potentially into the equity markets. Obviously, the other 17.4 trillion in term deposits, so fixed deposits. What we are expecting for 2026 is approximately another 10 of that 17.4 trillion will mature to become sort of readily available to be deployed by the Chinese consumer, whether it's on consumption or investments in various assets. So, I mean, at about 16 trillion of sort of disposable cash lying around by Chinese households, even if just 10% flows into the Chinese stock market, it's enough to, I mean, based on what estimates you look at, it's potentially enough to double the Chinese equity index. So it's not that easy to get 10% of everyone's savings into the equity market, but it just shows you guys the potential that can go through. One thing that's very popular in China right now is insurance, investment focused insurance products. And that's also very positive for the equity markets because a couple of years ago, the Chinese insurance regulators came out to tell all the big insurers in China who are all state-backed that they must invest 20%, at least 20% of all new premiums into equity markets. So we are seeing quite consistent tailwinds for the Chinese equity markets. That's why it's done really well over the past couple of years. So moving on to sort of a return recap for 2025. I know we're in March, but we haven't done a 2025 recap yet. So it's just to have a look at what the markets did. Obviously, South Africa on this chart doing absolutely amazing over the past couple of years. So 2025, South Africa returned 62.5% in dollar terms, dollar total return terms. China, on the other hand, on average across the two markets, doing around 26%. Very, very solid. One of the best performing emerging markets outside of South Africa, outperforming the US, way outperforming India. If we stretch that out over the last 2 years, because I mean, over the last few years, China's often been termed uninvestable, but since the beginning of 2024, over 2 years, China on average has returned more than 50% in US dollar terms. Again, underperforming South Africa, who was probably the best in the world, of the best big market in the world, biggish and liquid market in the world. China outperforming the US, outperforming UK, outperforming India significantly, outperforming Japan. South Korea is actually a market that did very well, but we typically don't include it because it's a very concentrated market, a small concentrated market. So if we look at the difference in performance between the Chinese onshore and offshore markets, the returns on this slide are actually not the focus point. I think the focus point on this slide is I just want to talk to just over a 1 year period of 2025. The volatility that we saw in the sort of offshore benchmark MSCI China index was almost 25%, and the onshore Chinese index, the CSI 300 that we use, only around 15.5%. So it's a major reduction in volatility in the onshore market. Again, we don't advocate for picking one or the other, but we believe it's important to have managed exposure to both Chinese markets, like we always say. In terms of valuations, all these numbers are updated to end of 2025, largely unchanged for year-to-date 2026 on a cyclically adjusted basis. Still, even after the 50% rally, China is still absolutely a bargain relative to the US and India. And even if we look at the dark blue line on the left-hand side, even a little bit below China's own long-term historical averages in terms of valuation multiples. So on average, China about a 56% discount compared to the US India. So you're getting almost a 60% discount for the exact same earning stream on average across the market. So still absolutely a bargain. We still believe global markets like the US and India are overpriced and carries more downside risk than the Chinese equity markets. This is one of the main reasons why we believe China is probably still the most attractive market to allocate to out there. Running through the correlation numbers, I think these we just try and do a bit of a reminder every few quarters on the correlation for JSE-based investors. Most South African investors have JSE as the majority of the portfolio. If you invest in the standard MSCI emerging market sort of allocation, you get about a 90% correlation to the JSE, which is not statistically a good diversifier. If you invest in the MSCI China Index, which is the most easily accessible index by global investors to China, you still have a 70% correlation to the JSE. If you invest in the Chinese onshore market, that's when you start getting diversification benefits because it's only got a long-term correlation of around 40% to the JSE. So the right allocation to China is still the best diversifier for JSE-based investors and probably also global investors. Okay, this slide is, I'm going to jump into, this is more of an interesting slide. And a disclaimer before I start the slide is I'm not a Huawei salesperson. We choose Huawei more because it's sort of the China tech champion and it is arguably the most sanctioned tech company by the US in the world. So this is a Huawei, one of the Huawei flagship foldable phones in China right now. Huawei is now back to either being the number one or number two best-selling smartphone brand in China. Remember back in 2019 when US slapped sanctions on the company and Google could no longer work with the company. So Huawei had to develop their own operating system. They've come a long way since those very, very tough days. This is a Huawei sports watch. This is one of the sort of very popular premium models that's on offer in China. It's actually real 18 karat gold for the gold part. A little bit flashy for me, but very popular amongst the consumer market here. This is a Huawei car. This is the ultra luxury premium sedan. So your competition to the Maybach, Bentleys, and potentially Rolls-Royce. It retails for around 3 million rand in China. Uh, but if it gets to South Africa, it'll be priced in the 6 to 8 million rand range. So it's your ultra luxury sedan. So this is the front seat inside the car. You can see the sort of the large LED screens, touch screens. But if you buy this car, chances are you probably have a driver sitting in front, and these are the back seats of the car. So absolutely luxurious. For those of you that actually joined our investor tours, I think the last couple of years we've taken the investors to the Huawei's biggest global flagship store here in Shanghai, and this car is on display there, although you can't go inside. But the progress the company has made is quite representative of a Chinese technological development. If we jump away from these nice looking photos and look at some stats, uh, this is a share of global electric vehicle battery production. So CATL is the largest EV producer in the world, and it's a Chinese company. So CATL plus BYD, two top Chinese companies alone, make up more than half of global production. If you add all the Chinese producers together, you're probably looking at around 65% or more global battery production market share. So again, another high-tech sector that China is dominating in. So companies like Tencent and Alibaba, uh, really dominant, really strong companies, but in China, they are more seen as old tech rather than new tech. Newer sort of tech champions are coming through in terms of hardware. You got your Chinese champion foundries, SMIC and Huahong Group, who are also sanctioned by the US, but slowly developing capabilities to start producing the most advanced chips in the world. You have your software-focused companies like Moonshot AI, Kling AI that we visited last year with a group of investors and DeepSeek. In the words of American AI model experts, the most advanced Chinese models are only 3 to 6 months behind the most advanced US AI models. So um, I think one of the things we are trying to illustrate on this slide is that if you want any diversification from in AI, from companies like your NVIDIAs and your TSMCs, your Intels and your Microsofts and Googles, there are no alternatives in the world aside from China. European companies are nowhere in terms of the entire AI industry. China is the only alternative, and the Chinese industry's valuation, although we feel are quite expensive, still much, much cheaper on relative basis compared to the US sector. So China pretty much really doing well, the only competition to the US and the only, obviously, diversification option for global investors. So we believe access to China and consistent access to China over the coming decades will be very, very important for your portfolio and especially your global allocation. Okay, moving on. So that's everything on sort of the China data update. Moving on to our China balanced, which is our flagship strategy. Most of you will be familiar with. Um, just a bit of a reminder, it's our all-in-one, fully flexible. It's not your typical sort of static 65-35 balance. We have access to all parts of China. And the next slide will invest. And again, another refresher, just talking through the three pillars of investing in China. The first pillar, your offshore Chinese listed stocks, MSCI China, for example, is the representative index, and then your China onshore market, also equities, onshore A shares, and then China fixed income. Very simple three pillars. The offshore market is about $5 trillion in size, a little bit bigger than London. So a massive market, but the onshore market is $16 trillion. So we think it's critical to have exposure to the Chinese onshore A share market. Together, the Chinese market is about currently $21 trillion. And you don't want to just have access to that 5 trillion block offshore. What we do is we ensure that the strategy has full market access and we dynamically allocate between the three pillars. In addition, we take advantage of arbitrage opportunity, then use derivative structuring to reduce volatility for the strategy. So looking at asset allocation over the last couple of years, the sort of big drop in the middle on the line chart on the left was a Liberation Day where we cut equities quite a bit. We were very bullish equities then. That's why we cut from close to 95 to just below 75 at the time. And we quickly added back as things sort of cooled down and markets normalized. What we did at the beginning of this year, 1 Jan, was uh, our exposure to Hong Kong was becoming very, very expensive, and a little bit of luck as well. We cut all our Hong Kong exposure to reduce our total equity exposure to around 65%. So essentially, the Hong Kong exposure is our China tech exposure. And since then, Chinese tech have struggled. So the fund has performed well on relative basis. Again, it's another example of the consistency of how models work in terms of our asset allocation models. Quite comfortable with that. If we look at 2025 as a calendar year, in a bull market, it's always quite difficult to try and keep up with the market index. But we managed the CSI 300 total return did 26%. We almost kept up with 100% equities. Did pretty well. And this is net of fees. Gross of fees would have been pretty much 100% of equities performance. So quite a solid year for 2025 in dollar terms, 24.7%. And then year to date, again, we're doing very well. So it's during times of volatility, and especially Chinese markets are quite volatile by nature anyway. So year to date, if we look at year to date figures, Prescient China balance doing 3.23%. All of these figures are net of fees, and all of the indices are total return indices. So we outperformed 100% equities as well, both in terms of the onshore and the offshore market. You can see MSCI China actually down 2.6%, and the onshore market up 2.4. So the onshore equities are outperforming MSCI China by 5% already year to date, and our strategy is outperforming the equity market by a further 1%. So very solid year to date performance. We'll continue to manage the volatility and the risk within the portfolio, especially with the Iran war happening now. Just there's an extra external factor for us to consider. Overall, the strategy has done really, really well. We've done inflation plus 8 since inception per annum. China inflation plus 8 per annum. Year to date, doing pretty solidly. And we really, so this year to date is at the end of Feb, and on the previous chart, it was up until 16th of March. So we include the first couple of weeks of March with Iran happening. So you'll see since end of Feb, the markets are slightly down. And then just our long-term brag chart, we continue to outperform pure equity indices net of fees over the long term. So cumulatively, we've now, since 2013, outperformed the MSCI China Index by 105%. Cumulatively, outperformed the CSI 300 by 64% and outperformed the MSCI Emerging Markets or Total Return Indices by 76%. And this table on the top right-hand side, if we look at the highest rolling 1 year and the lowest rolling 1 year, it's an extreme representation, but it's the typical return profile that we aim for. We want it to be asymmetrically biased for the upside. So when the market rallies, we try and capture as much exposure on the upside, and when the market tanks, we try and reduce exposure to sort of protect on the downside. And typically we try and achieve close to 100% of market upside over a cycle, and on average around 65% of market downside over the cycle. So over in Morningstar, our rankings changed slightly. We are ranked number 2 now globally as at the end of February over 5 and 10 years. A quarter ago, we were ranked number 1 over 5 and 10 years. But again, it just shows the competitiveness of our strategy. We are very, very competitive against the best in the world, literally ranking number 2. So the 3 and 4 are third and fourth percentiles out of the number of peers. So if you work out the percentiles, our actual rank is number 2 uh, globally in the China allocation category over 5 and 10 years. We expect a similar type of rank once our 15-year track record comes through. So this slide is quite exciting. So for those of you that were not aware, we actually listed our Prescient China Balanced Feeder actively managed ETF on the JSE last week. So as the slide suggests, the the JSE ticker for our ETF is Panda. So it's very, very easy to remember. It is the first actively managed China ETF in South Africa. You can access it directly with a JSE. You don't have to have a Prescient account. Just go via your broker. It can be traded literally right now on the JSE. It gives you access to everything our flagship Prescient China balance strategy has access to. So access to onshore A shares, offshore H shares, fixed income, and derivative structuring. So everything that you need. And the fee that we are charging on the actively managed ETF is 25 basis points, excluding that. It will obviously feed into the underlying dollar fund, which has another charge, but total asset management fee will be 1.15% excluding that. So just be aware of the total charges, but we would love all of your support for our Panda AM ETF, and you get exactly the same exposure as our Prescient China Balance Fund in directly in rands. Okay, so with that, that's sort of our the end of the webinar. I'm going to jump through the questions and then try and answer them sort of in order of what they were asked in. Just give me a minute. So first question from anonymous attendee asks if some news sources are saying that by the US taking Venezuelan and Iranian oil, where China gets the majority of the oil from, uh, they are trying to cripple China's economy. Uh, but so it's asking for my comment on those sort of speculations. So I can say with certainty that China will be minimally affected, especially by Venezuela. Venezuela exports heavy crude, and if the Venezuelan heavy crude oil is not sold to China, it's difficult to find buyers for Venezuelan oil. firstly. And secondly, I mentioned earlier Mark Carney's visit to China earlier this year. Canada is the largest producer of heavy crude oil in the world, as far as I understand, and China and Canada signed a deal. So it is very easy to replace Venezuela's supply from Canada if China wished to. So we haven't seen any concrete reports of China no longer buying Venezuelan oil. And then on the topic of Iran, I think I mentioned earlier, Iran continues to export. So Iranian and Chinese ships currently are reported to be allowed through the Strait of Hormuz. So at least now we have not seen any major disruptions. Of course, there are disruptions. There is obviously a risk that the US starts bombing Iranian tankers and potentially even Chinese tankers headed for China. But with the Trump's expected visit to China, we don't expect these sort of moves. So I don't think that's anything to be concerned about. Um, Yeah, there was another second anonymous attendee. DeepSeek is a private company owned by high flyer hedge fund. It's impossible to invest in. Do you have access? No, we don't have access to DeepSeek. DeepSeek is actually an open source model, so it's actually not something that's for profit. It's actually one of the major sort of differentiators between a lot of the Chinese models are actually open source. But let me go back to the slide where I had all of those pictures. Moonshot AI is also in private equity. So all our strategies invest in listed Chinese companies. Wait. I'm just going back to all our strategy invest in listed Chinese companies. So the out of these three AI, bottom left of the slide, out of these three, we are only invested in Kuaishou, which is the parent company of Kling AI. But we do have exposure to companies. Well, right now we actually have very little, but for example, we did have significant exposure to Alibaba, which runs one of the top Chinese AI models, Qwen. Our concern about AI is more the monetization of these AI models. So you are spending massive capex with very little income currently. So it's more just a valuation play currently until we see consistent, solid income streams from it. We have a question from talking about what is the talk on the ground about potential for a Taiwan invasion? And if it happens, what impact do you expect to have on the Chinese economy? So the Taiwan invasion sort of theory has largely been reported by mostly English media. If we look at domestic Chinese media, if we look at Taiwanese media, it's very far out of the major headlines right now. So we have a team looking at Taiwan consistently. I think I always say to clients, we spend at least on average four to 6 hours per week on developments in Taiwan. So if just a little bit of background on Taiwan currently, it's the island is in a bit of a political uh, chaos domestically and in terms of foreign policy right now. It is a minority government in the equivalent of the parliament. They can't get anything passed. There's sort of fighting internally, and to summarize it shortly, it's almost in a bit of a self-destruction mode currently. So. One of the major reasons why we don't expect China to do anything right now in 2026 is firstly, again, the Trump Xi Jinping meeting means that everything risky from a political perspective will be paused, even if there are plans. And secondly, time is very much on China's side. When I say China, mainland China side, China just needs to wait a couple of more years. And if we look at the opposition party in Taiwan, who are much more China friendly, it's just much easier to wait for the opposition to come into power in the next local elections and then national elections or presidential elections. And things can be actually sorted out without moving one soldier across the Taiwan Strait. So, not concerned about Taiwan invasion at all. The impact, if something crazy like that happened, would also not be major. So, the example we typically use is a comparison between the US going into Afghanistan versus Russia going to Ukraine. Uh, if China did have any military activity with Taiwan, it would be more similar to the US moving into Afghanistan impact rather than Russia going into Ukraine type of impacts. But we do monitor it very closely, and it's a very unlikely probability currently. Um, okay, Chinese 10-year bond yields are only 1.8%. Uh, what is the point of fixed income exposure? Yeah, very much agree. Chinese 30-year rates just a few months ago hit a low of around 1.6. And we have been saying to clients that we do not find any good opportunities in the Chinese fixed income space. That's why so we are very bullish on equities. So that at this current point in the cycle, we're very bullish on Chinese equities. We also don't believe Chinese credit offer good enough yield pickup. So you're getting compensated very little for significant credit risk that you're taking. So right now, within our cash positioning, we are just doing low risk, very short duration money market type of instruments. It's more just a risk management. We don't want to blow out 2% of the portfolio to try and pick up an extra 5 basis points. So that's our general positioning in fixed income. During the cycle, opportunities will come within the fixed income space. It's just not where we are right now. Okay, so another question on fixed income, on bond exposure. Hi, Tian, regarding bond exposure, please clarify what type of bonds there are and what the associated yield is. Are these denominated in dollars or CNY? So we do have quite a lot of CNY exposure. We do also have dollar cash exposure. More just for fund management purposes. The fund is priced in dollars and denominated in dollars, although all the underlying instruments are largely CNY based or Hong Kong dollar based. So we do have the sort of optionality to hold dollar fixed income assets, but even those we would typically just hold in sort of deposits, core deposits, etc. And we do hold with the largest four South African banks, but their London branches to get a little bit of a yield pickup. But everything right now in low duration, low risk cash instruments. And it also helps us easily deploy into the equity markets. That's sort of our view right now. If, for example, the Chinese tech sector corrects another 10 to 20%, we may go in very, very quickly. So, firstly, not much opportunity in the Chinese fixed income space currently. And then secondly, holding short duration reduces risk in the case that we want to deploy the cash very, very quickly into equities. Anonymous attendee, does Panda have the same allocations as the balance fund? Yes, Panda is just the JSE listed sort of conduit that feeds 100%, well, not 100%, probably like 99% because we need to keep a little bit of cash. It fully feeds into the Prescient China balance fund. So you will get the exact same exposure, but the RAND pricing will typically be 1 to 2 days lagged, probably on average 2 days lagged because of the time difference. There's a 6 hour time difference, etc. But you are getting the exact same allocations. Uh, Another question on Taiwan. I think the part of the question I didn't speak to earlier is there considerable trade between the two? Yes, there is absolutely a massive amount of trade. Taiwan generates its largest trade surplus with mainland China and Hong Kong. So it's actually the two are very, very closely linked by trade, which is why, again, we don't expect crazy moves because both sides are actually benefiting. It's just the politicians that are really not liking one another. The current Taiwanese president is a very anti-China president, and relations have deteriorated significantly since he came into power. But the good news is that I mentioned earlier, he only won around 40% of the votes, so he's got a minority in parliament, and the opposition parties are all way more sort of not necessarily pro-China, but more open to engaging with mainland China than the current party. So the two sides have significant common interests in place. Yeah, I think last question. 2021, 22 was a disaster for the Chinese equity market due to government policy mistakes. Can you give the assurance that the same mistakes will not be made again? Unfortunately, I can't give assurances on behalf of the Chinese government, but we have been so. What's happened since 2022 is that the what was globally termed as the draconian measures for the crazy COVID lockdowns at the time were very quickly reversed, pretty much close to Xi Jinping winning power for his third term. And if we look at the current Chinese cabinet, they call it the Politburo, um, it is probably some of the most market-friendly leadership that we have seen in decades. So Xi Jinping himself, as much bad market rep as he gets from American press, he actually came to prominence within the Chinese political ranks by sort of implementing modern market reforms, or sort of largely American-based market reforms in the southern province of Fujian back in his days of running provinces in China. He did the same in Zhejiang province, which is very close to where our offices are based in Shanghai. The man that's second in charge, Li Qiang, again, a someone that's known in the local business community to be very pro-business. I mean, he was the guy that handheld Alibaba from its infancy days to where they are today. So Alibaba's headquarters are in Hangzhou in Zhejiang, where the man that's now second in charge of China, uh, uh, sort of spent many years running the province. And if we look at them, I won't go into further names, but we are very confident that the current Chinese leadership is probably the most market friendly. And that's obviously different to what it was in 2021, 2022, where there were probably sort of different views within the cabinet at the time. So, for example, one of the things we mentioned is we actually hoping for Xi Jinping to win a fourth term just for policy consistency, and we expect more business-friendly policies as long as he stays in power and Li Qiang is the second man in charge. So, overall, that's our view, and yeah, I think that's all the questions. Feel free to pop us any emails. If you have any additional questions, again, our Prescient China Balanced Feeder Fund, the RAND version, is available on all major lists in South Africa. Our Prescient China Balanced US Dollar Fund is available on pretty much all the global lists, and they are available on all the South African lists, global platforms. And then obviously the latest edition mentioned earlier is our Panda ETF. I'm just trying to jump to that slide quickly. JSE ticker, very easy to remember. It's just Panda, and we would love your support. Yeah, go have a look. It's still getting loaded onto various platforms, like for example, Easy Equities, which is doesn't give the investor direct access to the JSE, but if your broker can direct access the JSE, you should be able to find it. So speak to your broker, and we'd love your support. Thank you for joining the webinar today.